So first and foremost, I'd like to welcome everybody to today's AMA. This is kind of an unorthodox kind of presentation, as you will, or it's kind of more of an educational effort on Jim and I's behalf to bring some much needed education to some advanced topics for members inside of our GAP program, as well as open up some education to some of you non-members to be able to see the potential of some of the things that we cover both in and outside of the school environments. Before I go into the details and the topics and the list that you're seeing here, and just a couple of things that I want to touch base on. We are recording it. We'll send that out post-event. Jim's here to answer questions. If I see anyone acting like an idiot, I'm going to remove you. You know who you are. Don't push the buttons. I don't have patience for negligence. We're all adults in here, and we came here to learn and advance. If you don't believe in something, keep it to yourself or question us, but don't be an idiot. You know who you are if you've ever been one, myself included, right? So that being said, this is really an educational event. I'm not here to give you investment advice. I'm not here to tell you where to buy or sell. I'm not here to guarantee performance, none of that stuff. I can't guarantee what's going to happen in the market, nor do I want to, and your trades are your trades. If you could just give me a why in the chat box so that I ultimately know you accept the risk disclaimers in the industry and you know that I'm not here to give you investment advice. I think it's important to understand that this is education. Fantastic. Okay. So why are we putting on this webinar? Well, you guys could probably guess we get a lot of requests. We get a lot of information coming at us from our chat rooms, from our ticketing systems, from our classrooms. And as you know, Jim and I put together a GAP program to teach price action. One of our most recent rollouts for the school has been a price action environment. And price action is no simple thing left unattained, right? I mean, there's a lot of things that you can do with price action. There's a lot of things that that can be done in relativeness to understanding higher time frames and smaller time frames, and understanding entry locations versus structure mapping and these types of things. And I'm here to tell you that this is not a basic level event. If you do not understand some of the concepts, I highly encourage you to join GAP. GAP's going to teach you the foundation of how to build a house. This is going to put some real sexy stuff into the queue. We're going to talk about some advanced stuff that a lot of people don't even know exists. Some of you may have been exposed to it. Some of you may have not been exposed to it. And we're going to look at multiple asset classes. We're going to look at futures. We're going to look at Forex. We're going to talk about some entry locations versus concept locations. Then we'll dial into how you enter trades versus, different concepts around the nature. And this is going to be the one of many. We're going to be putting on some of these events, and we're going to be diving into these details ongoing, mainly because it's a topic that never ends, right? We want to make sure that you get the most out of the education and you can leverage that, right? Now, what's nice to know is that, this information can be used on any platform. I'm not going to be looking at any indicators today. I'm not going to be looking at any tools that I've purchased or that you'll need to purchase. Whatever platform you're using, it's completely unique to you. As long as you can chart price, you can chart price, okay? So is everybody clear with that? Give me a Y in the chat box that everybody understands the room compliance, and we're not going to act like a bunch of monkeys. We're here to learn and here to be professionals and all that fun stuff, right? And how many of you guys in here are new? Type an N if you're new. I just want to know if you're new to us, new to trading, new to smart money concepts, new to price action, new to liquidity, just new, period, right? And how many of you guys are experienced? Type an EXP, right? An EXP. If you are experienced and you feel you've got some experience and you want to take it to the next level, good. So for all of you newbies in here, you're in the right place. I'm going to put a poll at the end of the event. Jim's going to reach out to you. We're going to get in touch with you. For everybody that's experienced in here that's not a member of the GAP program, Jim can also touch base with you. But anybody that's a member, this is just going to be great for you to expand. Now, we've got some topics. I'm not going to talk about structure mapping today. I'm going to do it manually. I'm going to do it automatically, quickly, and efficiently. You're going to want to know what structure mapping is. Maybe Jim, you can write a definition of what structure mapping is in the chat box. Everybody understands it.
Yep.
I'm not going to talk about preferred fractals for myself. I'm just going to talk about different variations. But I really want to talk more about, first of all, these four things. I think order blocks, fair value gaps, breaker blocks, and sweeps, they need a lot of attention. These are all concepts around trade location. If you're going to trade price, trading price actions about where am I getting in for a good entry? Where am I getting in for a solid probability entry? And they're all different. So an order block is, I would call, like the first dibs, right? It's the easiest to learn because everybody can see it. Everybody understands order blocks that have been in supply or demand trading, or ultimately any form of trading in terms of SMC or price action. What's an order block? Okay, well, let me just kind of map out what an order block is. Let me just, give me a market. Anybody give me a market. We'll find an order block on a market. I like doing it at whim. It's not picked and choose. Give me any market, MES. Okay, well, I'm on MES right now. So Euro USD, says Jasper. Let's go to the Euros because we're not on it right now. And so let's just take a look at the order block for a second. It's going to load the data. All right. So essentially, a great example of an order block would be, if I grab, I'm going to draw these. It's going to be easier for me to draw them. And then that way I don't have to sit there and structure map. I can use it with the draw tool so much faster. Think of this as like market structure, right? Boom, 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 boom. Think of that as a structure break. Some of you guys will know that as a boss break. An order block to the long side is the last down candle that led to the break of structure that created the impulse move. So a great example would be, this was a close. This is the last down candle that led to that boss break, right? If we look at, if I just map this out, we're going to go like this, boom, 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 push it up. I'm just going to draw some structure here. Okay, I'm just going to draw some structure here. That's the highest high. That's the lowest low. Just going to draw some structure here. Just going to do this manually. There's the highest high. This is the lowest low. This is all internal. Here we go. So these are all. So I'm going to redraw this one because let's take a look at these two. This is touching. So that's the order block here. I don't include that. These are some advanced topics that we'll talk about inside of GAP. But I just want to talk a little bit about what an order block is, right? An order block is basically, it's an inducement candle. The concept of an order block is it's the fake out before the move, right? So during this time, everybody's like, oh, the market's going down. And then it stops and it goes up, right? Well, this is an example of an order block, right? So an order block would be here, and I'm going to draw this. That's an order block. Why is it an order block? Well, it's the last down bar that ultimately led, okay, to the break of structure, right? That's a break of structure, okay? And why do people look at it? Well, because order blocks drive the market. They're what's leading. It's the last down move. Think about this. This is the last down push where everybody's like, oh, maybe they're going to go down. Maybe they're going to do this. It's a lower high. It's going to break down. It's going to continue a downtrend, whatever the case may be. But what it is it's an inducement candle. It's the market sucking in the liquidity before it primes the pump to pump. Now, everybody can see this. Everybody and their dog can see this. Okay. So one of the things about order block trading is that nobody knows if the market's going to respect the level. So if you think about this as a trade example, like nobody knows if this is going to be the level that comes in and rips like this, or nobody knows if the market's going to come in deeper and rip like this. Sometimes it overshoots a little bit and then confirms and then whips. And then sometimes it just trades right through and sucks everybody in for a stop out. Right? That's just nobody knows at any given time, any trade location. Can we all agree that nobody knows what's going to happen in the market at any given time? That's why risk management is introduced into trading, right? There's a level of probability that we can increase our odds. There's a level of things that we do as a trading community, as a group of traders, as an individual trader to try to increase our probability, our money management. But at any given time, there's a 50-50 chance in anything you do. Now, there's ways to increase your expectancy and your hit rates, and we'll get into that in a different discussion. But for the most part, if you're looking at this location, we do not know if this order block is going to work or not work. But we definitely know that there's an opportunity here to look at. So this is one type of trade location, okay? The next in queue would be what we call a breaker block, right? Or excuse me, a fair value gap. And this is what we call second dibs. I would call this second dibs because it's easier, but it's easier. It's not easiest, it's easier. Okay, it's not easiest, but it's easier. A fair value gap, in essence, is considered an inefficiency in the market. It's an inefficiency. It's a pocket of leftover liquidity. Okay, it's a pocket of leftover liquidity, essentially, that has never been tested, never come back to retest the market. And a lot of people don't understand what that means. And it requires 3-bar patterns to create it. So, and I'm going to just use this as an example. We're not talking about which one is going to be better than the worst. We're not talking about which one should I choose just yet. I just want to talk about the concept of what they are before I start talking about how to increase the probability of them. Because there's this 2-step equation. You need to first learn the setup. You need to second learn how to determine bias. So am I looking for longs or short? And third, you need to learn probability. I don't care who you are. I don't care if you're trading 100 years. Every single system is built this way. You need to learn a trade setup, but then you need to decide, am I going to buy or am I going to sell? It doesn't, as a system architect or as a quant or anybody that's building any type of strategy, whether it's retail or algorithmic, bias is direction. Bias is, am I going long versus short? And why? You'd be surprised how many people give me a different answer on that. Maybe it's to do with structure mapping. Maybe it's to do with maybe the 100's above the 200. Maybe it's whatever. Bitcoin's going up, so I'm just going to buy. Like everybody has a random thing at what they decide, right? And it's not about right or wrong at this stage. It's about this is the mindset that you need to start preparing yourself for any type of trading approach. You need to learn what you're doing first, which means you need to understand the strategy, but more importantly, learn where you're buying or selling. And then you need to learn determining, well, if I know where to buy and sell, when should I be buying and selling, right? When is a very important like bias. And then you need to learn how to increase the odds of your decision making. Like it's what can you do to stack the chips in your favor? Okay. So here's an example of an order block. Okay. I'm going to look at one that's unmitigated or untested. So we're going to just do this. This is a great example of a fair value gap. You get a candle's high-low here. And then you get another candle that closes up. But then you see this low of this candle. It doesn't come back to close that gap. This is called an inefficiency. Now think about this. Like, let's think about this from a liquidity perspective. The market closed here. The market came all the way back down to use up all of the order flow in the book from here to here. Remember, all you're thinking, most people don't realize this, but all a price chart is giving you relative information of time versus the price axis. We just use candles to tell us what the guys used to do in the pits. right? Back in the day, they used noise. Today, we use candles. So when you think about this, that candle told us a story about the order book, which is why I think fair value gaps have an advantage over order blocks. Write that down, guys. Golden nugget. Fair value gaps have an advantage over order blocks. Order blocks can be seen by everybody, and everybody knows that there's been trade activity there for inducement. This was the last down candle before the big up move. So that's an order block. But most people don't understand the fair value gaps concept. You get a bunch of monkeys on YouTube, a bunch of kids out of college start writing some SMC shit all over it. It don't matter where you get your information from. Most people are uninformed as to what is really going on here. The market tried to fill liquidity from here to here and could not, which means this is kind of like your spare can of gas if you're going fishing. And if you run out of gas, you pour it on the fire to keep going. This is what the market needs to prime its pump. Okay. And this is where a lot of people don't realize the difference between an order block is structure. Fair value gaps is pockets of order flow that have not been consumed. And this is a very big advantage to a lot of traders in that if you're sitting there, okay, if you're sitting there and, you know, you're looking at trade locations, a lot of people are going to look at the order block, but they're not going to see, okay, that there's actually two trades here. There's actually two trades that can be planned out versus one. And this is where I've now just increased the opportunity for all of you gap traders in here to stop just relying on order blocks as the only opportunity for an opportunity, right? I think I said opportunity way too many times there. So the reason why it's a trade entry is because sometimes they work way better than an order block. Sometimes an order block works way better than a fair value gap. How do we know the difference? We don't. So stop trying to put that pressure on yourself. Like for those of you out there trying to get it perfect, trading's not about perfection. Trading's about understanding. Trading's about decision making. Trading's about risk and execution and owning it. So if you've got 3 trades right here and you're sitting here saying, well, I'm going to trade all 3 of these, you've got a decision to make, right? How am I going to enter these trades, which we'll get into after? We're going to talk about execution once I teach you trade setups. Okay. Does everybody understand where I'm at so far? I'm just trying to show you a few things. This is an order block. This is a fair value gap. This is another order block. Okay. For trade locations. So I've nailed down these first 2. Now breaker blocks. Very unique topic. A lot of people get it wrong. I see a lot of people teaching it. They don't teach it right. So I'm going to open up the can of whoop ass here for all of you people that have been exposed to breaker blocks. Who in here knows what a breaker block is? Anybody here know what a breaker block is? Nope. Think of it as like a unicorn. If you had an opportunity to own a horse, you'd want to own a unicorn, right? Like when you think about breaker blocks, like if you can see them and you understand what they are, man, they're seriously powerful trades, like next level trades. Okay. And what I'm going to do is I'm going to basically show you some examples. The reason not everybody understands them is because they're harder. Okay. But more powerful. So wouldn't it make sense if you learn the easiest one first? Great. Then you don't need to worry about knowing it. You understand it. Get knowing. And all the knowing, get knowing, right? I think Bob Proctor said that. If you understand what a fair value gap is, great. Now you've got 2 tools in the toolbox. But sometimes you need a tool that's superior, but not everybody understands it. So let's teach it. I'm going to go and take a look at the Russell. I think the Russell had some great examples on it. I seen some yesterday. I'm going to cherry pick an example for the sake of wasting your time in a webinar trying to find them. But I think that they're very powerful, so we're going to talk about it. We'll go back to the euro in a. This is the euro. We'll go back to it in a second. Okay. So I'm going to switch this to extended trading hours. I can take a look at it. Take a look at this. So we're in a downtrend, right? So I'm just gonna like, for the sake of keeping it super simple, pay attention to the clearest direction. Which that, down or up, guys? Like, do you want to be fighting the market or going with the market, right? That's the simplest decision here for this example is let's stick with the market and let's basically just look at it from a negative perspective, right? Not negative as in bad example, a negative from we're going to talk about the breaker blocks, okay? And let's go in here and take a look here at the top. I think this is a great example of when the market shifted. Okay, this is the transition. The market was in an uptrend, right? And then it shifted to a downtrend, right? Well, there's some things that happened in this uptrend. I'm going to change this to a different contract so that I can continue this back adjusted. There we go. I just want to be able to see I don't want the gappy data. So we're going to get into that in a second. There we go. I just want it to be a little bit cleaner from a price action perspective. Okay. So I want to draw something here to kind of explain the story. Okay. And in structure mapping, this is advanced. So this isn't for the newbies in here. If you want to catch the basics, be a part of GAP. You want to learn a golden nugget, a unicorn level concept, understand that it's going to take a few times of hearing it and learning it before it sinks in. So I'm just going to draw the market. Okay, I'm going to draw a structure. Okay, we're going up, down, pushing up. Okay, there's the lowest low in the pullback. That would be considered the boss. We cleared through it. We had a pullback. This is the next structure break. I'm structure mapping visually right now. Okay, I'm just going to go up. Okay, there it is. We came back down. This is a strong low, mind you. This is a strong low. So we're going to draw that line across here. For those of you that have been in the gap trading room, you understand what a strong low is. It's a low in control. This is all internal. Okay. This is a strong high. Okay. Never got through it. Okay. Never got through it. Came through, wick through, came back down. That's a great example of a failed attempt to break higher. Okay. Now that high is here. Okay. They close down. Okay. Another great example. There's two types of breaker blocks. One of them is on a failed strong low. And the other one is on a lower high strong low. There's two types of breaker blocks. We're going to talk about this. The pattern that I'm going to show you is this is a strong low. And this is a weak low. Breaker blocks are the order blocks that fail and they basically become broken. So when you think of it as broken levels of support and resistance, I want you to understand that a breaker block is an order block that failed. And they can fail from two scenarios. So we're going to basically show this. We're going to make this a little easier to see. I'm just mapping this out so you guys can see this. This comes down, pushed all the way up, and we closed above that. We closed above. So there was a close above that. So this becomes the last breaker block right here. That's the order flow candle. This is inside it. That's the last order flow down bar. That's the order block right here that led to the break of structure at the top. Does everybody understand that? Who knows what I'm talking about? For those of you that understand what I'm talking about, type a yes in the chat box right now. There's a down bar that led to the break of structure. Not everybody knows it, so you can just type everyone in here if you want to, whatever you want to type. So everybody understands that. So let's just draw that in here for a second. So I'm going to zoom in for those of you that are new. Wow, you're in the right place. Okay, let's go here to drawings. I'm going to draw a horizontal rectangle so you guys can see this. This is the order block. This negative candle is not the order block. It's inside the prior one. It's an inside bar. So let's do this. So let's just draw that. Okay. So if we're coming, a breaker block is an order block that fails. Now, if you draw your order block in the wrong place, your breaker block is rendered useless, right? So this is why you can't understand a breaker block until you understand the order block. That's that. Like, it's that simple. Like, that's why I teach you the order block first, because a breaker block requires an understanding of a failed order block. Now, I'm using, excuse me, a 240 chart for simplicity, keeping it simple on a higher time frame. We'll go down into smaller time frames in a bit. The break of this order block, okay, happened here. This is not a break of the order block. That is a test of liquidity. So if I'm going to draw this, and there's the strong high, okay. Yeah, if you came in late, there's no way you're going to catch up. You need to watch the recording. Yeah. So let's just draw this. Okay. Now let's just talk about this for a second. Technically, this is the strong low, right? This is internal. This is a weak low. Remember, it can be a strong low, which is this, but this is a weak low. You say, what the hell is the difference? Well, it's internal structure, which is, you won't know this unless you're in our program. That's the strong low because it's the order block that was the lowest low that led to the break of structure. This is the weak low internal structure that led to the break of structure. So this is the strong low, and this is the internal weak low. Let's go into this for a second and let's map this out. I'm going to draw another box. This is inside of this. So therefore, it's all part of the same order block. So let's draw this. I'm going to draw two boxes here for a second. So now what we're going to do is we're going to talk hard right edges if we're coming like this. Okay, let's just pretend I'm looking at it like this. And you're a trader. Okay, you're looking at the market like this from the hard right edge. You're thinking long, market's primed to go long. You know that's a strong high. But this is the strong high, but it wicked through, so you can assume that's the strong high. It's got to clear through here, and we closed above it right there. That becomes the boss, the true boss. Okay. This is the lowest low that led to the break of structure, which is the strong low. This is an internal low. It's called internal structure. It's an internal boss, right? Jim, it's an I boss. And so when you think about this, there's two order blocks here. One is the strong low, one is the internal boss. They could come in. There's the wick. You can see this. It came in. This is a 240 chart. Remember this. This is a 240 chart. So if I draw a circle around that candle, we got a pretty strong reaction out of that order block. Okay. But that's not the topic for a breaker block. The breaker block is that once this becomes mitigated, we need to see a break of structure clear the low that created that order block for it to be a true breaker block. So what does that mean? I need a candle to close below this low. A clean break, not a wick through. I need a clear bust. Not that. Take a look. They came through and they sucked that liquidity on that wick. They came up. It was a profitable trade. That's the boss break of the internal boss. Not a boss. That's the break of that order block. That candle is the break of that order block. Okay. So then what we're going to do is we're going to take a look. The next trade location right here, that is the breaker block right here. This is the breaker block trade. It's a very powerful setup. We're going to take a look at it when, like, that's a 240 chart. The breaker block is a very powerful setup. It's once an order block fails, once you get a clear break below the low that caused it, that's the break. That's the breaker block trade. Okay. This is a completely different trade setup. Now what we need is we need to go in Rectangle, let's do extended line. So once we can get below this line right here, okay, we close below it, because that's the low that led to that breaker block. Wait for this one to fail. There's the wick through. Didn't clear the lows right there. At that candle, you now have the ability to plan a breaker block. The breaker block is this entire zone. This entire zone is the order block that failed. Just like this entire zone is the order block that failed. So an order block can be traded from this side profitably, and then from this side profitably. Every location is 2 trades. This is where you start opening up opportunity for those of you that are looking for more execution. How many of you guys would agree that sometimes you're sitting on the sidelines waiting for the order block trade? Yeah? It's time to open up the chest, Pandora's box, right? Well, what does that mean? Well, you all know the order blocks. That's the easiest one everybody teaches. You now are going to get fair value gaps. We're going to get an opportunity to discuss what a fair value gap is. And then now you understand breaker blocks. So you have 1 trade, 2 trades, 3 trades in your tool set following the same concept. So let's continue down. There was the first attempt inside of that breaker block. Pretty big trade. It's a pretty big trade. Down. Now this can be done on any time frame. There's the retest of the breaker block, which led to that. Yeah, more setups equals more money. But if you don't understand the first setup and you don't understand, everything starts with structure mapping. I don't have time to teach it today. It's impossible to teach it in one lesson. So let's just go in here and let's just do drawings, text. I don't even know where it is. Give me a second here, find it. All I can say is that let's do this. The first thing you need to do is mapping. The only way you're going to learn mapping is inside of the GAP program properly. You have to be with us in the trade room to understand mapping. Mapping is like breathing. You can't live without air. You can live without food. You can live without water for days, but you can't live without air. There's no way you'll understand price action without understanding mapping. Once you understand mapping, okay, check mark to you for learning it, because once you learn it, you're in the top 5% of traders. Once you understand structure mapping, you are literally in a different level of traders, period, because you can apply it to any time frame, any market, anything you do with any system. If you learn structure mapping, if that's the last thing you dedicate yourself to this year, become a master at structure mapping. And then 2, just focus on entries and management. Entries and risk management. You need to get good at entries and risk management, okay? So let's just talk about breaker blocks again here. Let's just keep going down from a breaker block perspective, okay? Remember what we said, like if I'm moving down now, let's just continue down on this trend. These were trade setups to the short side. And if you think about it, this is a pullback, came up, strong low. This is the strong high, right? This now becomes the push down, okay? This now becomes internal structure, okay? Internal structure. So what we do is you map out the last down bar, okay? Remember, when you think about a breaker block can be from a strong low that fails or a weak low that fails. So if I'm looking at it from the short side, a breaker block can be from a weak low or a strong low that fails. This is a weak low. It did not clear above strong structure. This is considered a weak low. Did not clear above the structure. Did not clear above the structure. So if you think about, there's an order block in this pivot that even if you're not waiting for it to return to a strong high, you can be participating in the breaker blocks while waiting for the other setup. So let's talk about that for a second. if I know that this is an internal pullback, if that's the strong high and it didn't break it, but it doesn't get back up there to basically give us the trade. Like this was an order block trade that worked. Like this is a real order block. The last inducement candle up. I'm going to draw another. This is a short order block that a lot of people would understand if you're mapping out order blocks. Let's go in here and draw the rectangle right there. So there's the last candle that led to, this is the last candle that led to the break of structure down. So there it is. So this is an actual order block that basically led, that was a breaker block and an order block inside in one location, which is why it was such a powerful short. But there's also the last down candle here that led to that pullback, which is an order block in and of itself. If you think about this, same thing, this is the last down candle that led to that attempt to break the highs. It failed. This is still an order block. It's just not an order block that broke structure. So this is something that a lot of people don't understand, is that with breaker blocks, you don't need to break the strong highs or lows for it to be valid. Oftentimes, these will fail because the market's in a downtrend, and therefore you want to trade the other side of it because you're trading trending markets. This is the difference between catching the trend versus always waiting for internal structure to always go to the strong high and controls. A lot of times you don't get that. So let's go in and map out this breaker block. Rectangle, boom. Here's the last down candle that led to the failed high. And then if you think about, let's just draw, this draw price level, horizontal line right here. This was the boss break that led, this was the structure break. So we got a clear break of structure here. They came back in to test the breaker block and drop. So when you open up the understanding of what standard order blocks are versus fair value gaps versus breaker blocks, let me just kind of show you some things about confluence that you may not even have caught. What are you seeing here on this breaker block that I haven't talked about yet? This was kind of like, oh, wow, I didn't even know that that was an order block inside of a failed breaker block. That's like having two trades at once. Michael says gaps. Okay. What are you seeing on this last breaker block that I haven't talked about yet? There you go, Jack. Fair value gap. So this is where now what we're doing is we're stacking chips. We're stacking chips so you understand how to put the pieces together. There's a fair value gap inside of a breaker block. Imagine that. Why is that where the most powerful trades are? Why is that where the most powerful trades are? Like, I'm trying to show you how to take things that nobody pays attention to. Nobody sees that shit. Nobody spends as much time behind the screens as us, but it's crazy. Okay. Do you see where I'm going with this? Like, I'm not trying to teach you a strategy here right now. I'm trying to teach you how to nail the unicorn trades. We'll teach you the strategy in the classroom and the trade rooms. I'm trying to teach you shit that like nobody's going to show you. Okay. Because it's powerful, but most people don't understand it. Okay. And these are confluence trades. So let's just map this out again. Let's go back. And this is just an example, right? Let's take a look here if I can see another example. I was going to try to find some other price action, just random examples. Great example. So if you look at this, market's coming down, market's coming down, right? Market's coming down, market's coming down, boom, push up, boom, got through, took out the strong high. That's a strong high. That is a strong low right here. That's what broke the pivots here. Okay. Then we came up, pulled back, had another break. This one failed. This one failed right here. So this is a weak low. Okay. This is a strong low. Okay. So let's just draw these for a second. Let's go in and draw the price action for a second so you can see it. In that, if I'm going to draw these breaker blocks, these are breaker blocks just to kind of show because they failed on the opposing side. I'm trying to teach you breaker blocks are harder to see than the others, so I'm going to spend a little bit more time on them. The rectangle. So let's just draw this out. This was the last down candle that failed. Do you see this big down candle here? And then the market tried to pump up. If you pay attention to price, this right here could not get through it. And then this was the lower high. So technically, if we're looking at it from this hard right edge, right? If we're looking at it from here when it was happening, okay? This is where you can see the failed order block. This is ultimately right there, a close, a wick slash close slash, there's the down candle, the inducement. Does everybody understand that? That's the order block that is there. Okay. And then what ended up happening? We broke right through it. So by definition, it becomes a breaker block. So let's just draw this here. That becomes the breaker block. Okay. Now we cross through it a little bit, but that's not a failed zone. That's just a wick through taking liquidity. That doesn't mean you enter on the first touch or the middle of the zone. We haven't talked about that yet. But this is a breaker block. But then you're not seeing, where do you see the next move here? Like there's, it's kind of an interesting, you can't really see it. Let's take a look to this. There's the move down. This is the move up. This is the move down. This is the last down candle that led to this move up, but it failed, right? So if I draw a box around that big freaking zone, that big breaker block, that big down candle is a breaker block because it's a giant freaking down candle that led to these up moves. You might be able to go inside of that 240 to get a better view of this. We'll talk about that after. So let's just draw a rectangle. There's the breaker block, that big red candle. And then inside of it, what are you seeing here? Like, this is where, like, you really get to pay attention to, like, risk reduction by leveraging breaker blocks and inefficiencies in the market. The market has to. So think about the breaker block as the hardest to learn, but the most powerful concept. And think about a fair value gap is that the market has to 100% fill it at all given times. The market will never leave a fair value gap unfilled. So there is always a guarantee that the market will return to that level. It is, it's a certainty. There's no like, well, maybe it will fill. It has to fill. The gap has to fill. Gaps fill. That's just, orders get filled. In an efficient market, orders have to fill. So there's a fair value gap right here. Inside of that, there's also a fair value gap here at the edge of that. So let's just map them out. Are you guys learning something from this? I hope I'm not just speaking off the cuff and trying to, let's just talk about this. No shit. It's not an accident that's what drives the market. Yeah, there's reactions all over the place, but we're talking about needle moving shit here. Right? Like, I'm not interested in teaching you all the shit that everyone else is showing you. Go Google that stuff. Waste your time on this. This is stuff that if you're going to really understand efficiencies in the market, learn it from someone that can teach it to you properly. Now, I'm not talking about bias yet. I'm not talking about all that other stuff yet. We haven't got there yet. Okay. This is confluence, breaker blocks and fair value gaps. You're not going to get breaker blocks, order blocks and fair value gaps overlapping. You can't. You can't have an order block that's a down bar with a high low A fair value gap cannot be inside the order block. The order block is a consumed price level. The order block has all of the prices inside of it. There can be an order block below there can be a fair value gap below it or above it, but not inside of an order block. So when you think about confluence, think about trying to find an order block inside of a breaker block. Like think about this as this is technically the last up bar before that drop. So there's a fair value gap inside of a breaker block. There's also an order block inside of a breaker block. So if you're going to use these, look to bring the confluence together. Does this make sense? Everybody with me? Okay. Give me another market. Any market. Hit it to me. NQ. I don't have NQ. I got MNQ. Let's take a look at MNQ. I can already see the breaker block. Like I can just tell you right now, this isn't even to do with bias. This is just, I can already tell you where the breaker block is just by seeing market structure. Like if I'm just drawing this, boom, 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 boom. I can tell you right now, there's a breaker block right here. It's the failed order block. It's also where the market came back down to retest the reversal of the market. Breaker blocks are what everybody's always trying to go with the market. Don't blame you. That's what you learn at the beginning stages of trading. But what happens when the market doesn't keep going? What do? You just sit there and just, oh shit, like I got to stop out. What do I do? No, you have to think from the other lens. Let's go here. Order block that led to a break of structure. These are all inside candles. This would be considered what I would be the pullback because this was the high and this came back several times and then this broke up. So there was the break of structure. Order block. Okay. But think about where you are on the curve for a second. Like I really want you to think now for a second. Like if I'm trading, and you know, Jim, if you're here, I know you'll kind of talk on this. Like if you look at the impulse leg, we talk about wholesale versus retail. Yeah. This is retail in the uptrend. This is wholesale. Cheap, expensive. So if everybody's up here going like this and we're trading with the trend, boom, 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 you're trading with the trend, right? Okay. I get that. The order block is here. Okay. Yeah, maybe you want to reduce risk and try to get a confirmation entry down here on the 5-minute. That's fine. But in the big picture, when this fails at this part, what is that proving? Like when this order block fails, when that order block fails, and we're sitting here like this, and we go into that market, and you say, well, we're going to 50% from here to here. You're probably going to try to look to get into that zone down here with a confirmation entry zone in, right? Okay, that's fine. That's one way to look at it. You're going long in that order block. I get all that. But when it fails, what are we doing? Are we sitting here waiting on our hands and knees? Well, let's wait for the next shift and let's wait for the next rotation. And then we got to wait for 3 days for this order block to set up at the higher high. Like, holy frig, man. Like, fuck, that's a lot of time waiting on the sidelines. Coach, put me in, man. I'm special teams, but I want to play on the first line, so to speak, right? How many of you guys have ever watched football and like special teams? Nobody ever gets to play the game. So what I'm trying to do in this webinar is expose you to, as soon as things start to happen that you know are happening, you're all going to have a break of structure with an order block, and eventually that order block is going to fail. That's guaranteed. At one point in time, that order block is going to fail. What do you do? Why not take the opposing side of these with confirmation of really high probability opportunity? So let's take a look at it. Didn't close yet. Didn't close yet. Didn't close through the wick. You see this wick here? Didn't break below it. Didn't close below it yet. There it is. So now there is, let's just bring it here. There's the picture. Okay. So there's a picture here that's telling a story. Anybody here see the story? I just want to know what you guys see versus what I see. I know you're relying on me to teach it to you, which I'm going to tell you the answer, but let's just see if anybody's really Johnny on it right now. For those of you, there's a few of you. God, heck. Okay. Al's just always going to answer fair value gap because he never can go wrong if you just pepper it in the chat box every single time. Good job, Al. It's always fair value gap. Not in this case. There's no fair value gap here. What do you see? It's an order block. The last up bar before the break is structured down. This is an order block. This is an order block. Same concept. If there was a fair value gap, you would use it. But this is the order block. This is the inducement candle that led to the break of structure down. So you have an order block inside of a breaker block. Think of this as like two trades backing up the confirmation. This is the whole point of this AMA, is mapping out confluence in concepts that a lot of people don't even understand. I really got to shorten down my favorites list.
When's the last time you used a GAN fan?
GAN, baby. Let's just take a look at this. There's the order block. The order block is inside of the breaker block. And isn't that where the big trades happen? Ben, someday, all of them. It's going to take time. Great question. Ben wants to know, when are we moving all of the ARC indicators into Tick Blaze? As soon as we launch Tick Blaze in the next 1 to 2 months global, our entire inventory is coming into Tick Blaze. Yeah, the entire product line, all the indicators, all the algorithms will be built inside of Tick Blaze. Yeah. Yeah. So that answers your question there. Yeah. So it just takes a bit of time and a little bit of support from our community to help us get through the last minute hurdles. We'll talk about that after. So this is a concept that this is the NASDAQ. Okay. So let's just take a look. Okay. So now we're up here. So let's just talk about this for a second. Okay. Let's delete this because this was one example. Let's delete this. This is another example. Okay. But remember, this was the breaker block and the order block that led to the short. Okay. But now the market's going this way. Okay. Market's going this way. Now we're trading with the trend. So in a perfect world, everybody's going to wait for the strong high. Doesn't have to be with breaker blocks. This is the strong high. This is a weak high. This is a weak high. Okay. So I want you to kind of picture the last down candle that led to the pullback for internal structure. The last down candle that led to the pullback for internal structure. Now this candle here is inside of those candles, so I wouldn't do that. I would just basically create one zone to keep it simple. Let's draw it. That's the last down bar that led to those two internal highs. This is an internal high. This is an internal high. This is a strong high. No high broke the strong high. So if we're looking at the breaker block, it doesn't need to be from a boss. It can be an internal structure move. It just needs to be a clearly defined order block that led to a move in price. So there's a breaker block. Okay. Let's go here. Let's make sure that we get a clear defined close below these lows. Closing, closing, okay? Closing down. Does everybody see this? Now think of this right here. I want you to just kind of picture this for a second. Now you can sit there and tell me that this candle is red, but is it really red? Is it really green? It's nowhere near. It's a doji. It can be an up candle or a down candle, right? Technically, it doesn't make any sense to decide if that's bearish or bullish, but it did close in the upper part of that price range, more so than the lower part. So you could sit there and you could argue that's negative or positive. Either way, I'm going to draw a zone around it just for the sake of being clear with this. And isn't that where they came back to test the inducement of the breaker block plus that doji that led to the breakdown? That's an inducement candle that pushed down. And where did they come to? Right inside the confluence. So here's the goal for today's webinar. I don't care if you get it perfect. I just care that you understand. The goal here is to take a combination of these three and stack the chips. Can everybody promise me that they're going to spend time learning this? How many of you guys found that concept valuable to understand the confirmation between the breaking of a prior level to the confirmation on the opposing side? It's a double whammy. It's always a double whammy. It's basically taking the two most powerful things you're doing and combining them on the flip. Okay. Now, we haven't talked about something else, sweeps. What's a sweep? Well, sweeps are not, most people don't understand them. I'm going to teach you a sweep. A sweep is like whenever you have multiple price points that are easily seen by the market. Okay, so like you can, and normally they're equal in price. So like you can see here, there's a price point. This is what we consider a level, right? Like most people can see that this would be considered a price point. Like these are what we call these ledges. Like think of it if you're on a balcony, okay, and you have a ledge and you're sitting there, okay, and you're looking out over the ocean. You got a cliff, right? Nobody wants to jump off the cliff, right? Nobody wants to jump off the balcony. Well, maybe some people do, but hopefully it's into water or into something that's not going to kill them, right? Now, that is a cliff, but it is not a cliff like a balcony. It is a cliff of order flow that underneath this is like a pool in the ocean. And there's fish here. Okay, big fish. And what happens is in order for the market to go up, it needs to have liquidity to fuel it. Sweeps are like resting liquidity pools. I want you to think of it as like I'm going fishing, and whenever you have an opportunity to see these cliffs, think of it as an untapped pool of fish that you would want to go fishing for. What you want to do is you don't just want to take sweeps all over the place, because if you take a look, there was a sweep here. But what did it do? It went through and then it took off. Like you don't just put a buy limit down here and buy every time the market breaks a sweep, or just put a sell every time the market takes a sweep. No. You want to look for locations of sweeps. Okay, and this is going to be fun. It's going to give you some homework here. Think of this as a line of liquidity. Okay, right here. Give me 1 second here. Think of this as a line of liquidity right there. Okay, and if we're looking at it from here, what you want to do is you want to look at the level and think, I got to go into the ocean to see where that fish is. There's the order block directly below the sweep. So what normally is going to happen is the market is going to basically try to come into an area, an AOI, that is at a key level of liquidity. It's not always all over the place. Sweeps are not everywhere. So when they happen, be grateful for them. It's kind of like, wow, we have a sweep coming. Great. Think of it as an opportunity. And so if I'm going to basically drive this down, think of there's the order block below the sweep. So when they come into this area, Remember, this is a 240 chart. That's a strong reaction as a day trader. That's an even stronger reaction as a day trader. These are 240 charts. The reaction from this is very powerful because they're priming that pump. Okay. And then what happens, comes back down, comes back down, comes back down. There's the internal. The sweep did not have enough mojo to lift the market. What did that last down bar before that up move become? Another breaker block. So this becomes the next breaker block here. And now we're at current price. Haven't even touched it yet. That's a trade location. Why? That was a failed order block that was from a sweep that created another breaker block inside of it. Interesting concept. Stacking the chips. Okay. And so this is why I am very excited to share this with you, because not a lot of people teach it properly. Now, we haven't combined it with structure mapping. So clearly, if we know that the trend is up or down, what you want to do is you want to stack the chips on your side for things that make sense to do so. Now, to anyone here that's not in structure mapping, and if you're looking at a very simple thing that you could be doing, very simply put, just add a 100 and a 200 EMA on the chart. If you're not in our gap program and you're trying to understand, well, which side of the market, whatever time frame is your higher time frame, add a 100 and a 200 EMA. So let's go here and add these moving averages on. Let's just do this exponential moving average. We're going to load it on here. So let's go down and let's just change this to a 100 period. Okay. I'm just going to change these into the colors. There we go. Well, let's change the color. There we go. So there's the 100. Okay. Now, if you were to add the 200 in here, you're going to see, let me just go in. You can just take whatever you want. You can add, this is more for those of you that are not in the, let's see this. Parameters, there's the 20. Let's just do this to 200. Okay. I'm just going to show you why I'm doing this. Okay. So this is kind of like you got the 100 below the 200, right? Like, let's double check here. This is the 100. I think it's, I just want to make sure I got these right. Wow, that's not right. 2000 EMA. Holy shit. Give me a second here, guys. I've got, that's why it's a double exponential. I'm going to remove this and exponential moving average 100, 200. So let's go in here to exponential. Give me a second here. I'm just going to find an exponential moving average. Exponential moving average. There we go. And we're going to add it to the chart and we'll put a 100. And this one is a 200. 200's red, 100's white, and we're good. So why is it doing that? 200 and 100. You guys get the point. 100 and 200 down. Okay. If you have a 100 going down and a 200 like this, if you're not in our, if you're not in the gap program, you're not going to be knowing structure mapping. If you are in the gap program, well, then you're in a really good place because you're going to follow structure mapping. You're going to be on the right side of structure mapping to know the direction. Let's go back into the Euro USD for a second. Let's just talk a little bit about some of the concepts that we talked about on sweeps and stuff. Let's see if there's anything, just looking at a random market. Okay. Okay. So let's take a look at this for a second. Okay. If you can see here, like does anybody here see a sweep that I can see that, may not be, let's just do this. If I was looking at it like this, can anybody see that we've got a ceiling? We've got 1, 2, 3 sitting there. It's a ceiling. Okay. And a lot of you are going to look at the ceiling and say, okay, well, where above this can I look to take a trade? Like, where up here should I look at getting into this? Now, sometimes you're going to have the ceiling here, and think of this as the ocean with the big fish that's saying, hey, come and eat me. But the question is, where here? Like, where do I take the trade above that ceiling? Do I take it up here? Do I take it there? And if it's not clear on this time frame, then go up a time frame. Because as you go up a time frame, you stack the probabilities. Don't go down in the time frames. Go up in the time frames. Everybody wants to go down into the day trading shit. Well, that's where everybody gets smacked from the stop outs left, right, and center. Before you time your entries, you need to know where you want to trade, right? We talked about the first thing you need to do is get good at the entries, then get good at execution. Well, if I'm trying to basically put a zone in here, okay, let's just do this for a second. Let's just do it like that. And we'll draw a box. Okay. Right. There's the ceiling. Okay. There was the ceiling here. We're not going to worry about this short right here. I just want to talk about why it reacted here, because we don't know where to place that trade here. If I'm looking at it like this and I'm sitting in the hard right edge, I don't know what it's going to happen over to the right. Like, I don't know if it's going to drop down or go up. So think about this. If I know that I've got 1, 2, 3 ceiling points, there should be a resting level of liquidity above here for me to sell. But the question is, where? Do I just take the last order block that led to this down move? Sure, that could be one concept, but it's messy. There's like 7 freaking up bars in here. And there's no fair value gaps in here. There's no spaces. The next fair value gap is right here. Could be. You could say, well, but think about this. The ceiling's here. That fair value gap is up here. No way are you going to be trading this thinking it's a sweep. Like, that's a day of price. That's 2 days away from you. So think about this. If I'm sitting here with a sweep like this, and right above me, there's this information that tells me, okay, where do I take a trade? Go up. Go up in the time frame. Go to the daily. Right? Go to the daily. And what do you see here? Rally, base, 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 drop. Okay. That's the last base candle on the daily that's sitting right above it. Right. That's a strong level of supply inside the daily. Okay. The other thing too is you can take a look at this is structure on the daily that is there right above that ceiling. So this is where you get a chance to kind of, every situation is going to be different. This is one example. We can come in and you can say, well, why did this react right here? Because it took out the ceiling and it filled the liquidity in here. Okay. And this is important, right? It really, really is important. Another thing you can do here is this is an order block. These two candles are inside of each other. So this is an order block, the last up move before the break of structure on the daily. That's pretty significant information for all of you guys that are in the program and you understand this. I'm going to go in and just draw a box around this. This is the order block of the daily that is sitting right above the sweep. In a second here, I got to go in here, add the data series back so you can see it. Why would I want to rely on a higher time frame piece of information to tell me? Because that's exactly what the big guys are doing. They're sucking everybody in on the 240 and the 60 and the 15 and the 30, and everybody's trading this uptrend. Wow, wow. And then holy shit, what just happened? Well, wait a second. This is a liquidity pocket that met the ocean for the banks. That's all it was. And this is why you don't put a pending order here. You look for what's above it. to basically decide where you want to enter. These are advanced. I'm not expecting everybody to just be like, okay, that's great in theory, Sean. You show me one example, blah, 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 right? I don't expect you to understand everything about sweeps in one environment. Give me another market. Let's go find a sweep. Any market. I'll walk you through the process. Breaker blocks, order blocks, fair value gaps, sweeps, we'll tie it all together. Crude oil, great market. Let's go find crude oil. Crude oil. Switch to extended trading hours. Perfect. Amazing. I can see an insane trade happening right now. Insane trade. Can anybody see it? Jim, do you see it? I'm not, if anybody gets this right, I'm gonna buy you. Do you see what I'm looking at? This is a hard one. You're gonna say no. No? Yes? What do you think I'm showing? Because I'm looking at the hard right edge and I'm trying to find what's the next trade on crude. I'm going to give everybody a trade on crude right now. Anybody here? Willie's like, the pound. We're looking at crude. I love it. Right? Does anybody want to take a guess at what I'm taking a look at? Just by looking at this, I'm here. Where is the next trade for me? Based off of what I just said, I've got order blocks. I've got fair value gaps. I got breaker blocks. And then I got sweeps. I'm not saying that there's a sweep here, but I just want to see if anybody here. Sweeps are sometimes. Just remember, not all sweeps happen. Sweeps are not everywhere. So what I'm going to do is I'm going to draw this from the other side first, because most people don't think like that. What just happened here? Something had to fail in order for this to shift. So a failed order block, which I guarantee everybody was looking at inside of our trade room. There was the down bar on the 240. This is important for all of you guys in our trading room so that you can know that this is relevant. There's the last down bar, right? That led to the boss break. And I guarantee you everybody was looking at this inside of our trade room. Jim, if you weren't, then what are we doing?
Right? We took that trade.
Right. And did it make money?
No, we got stopped on that one.
Okay. Well, we'll get into that in a second. So this was the 240. There it is. Okay. So if I'm mistaken, you probably went down inside of this area and you went into a smaller time frame to zone refine that risk. Correct me if I'm wrong.
Yep.
So everybody went down into this time frame to zone define that risk. Okay. What do you see here? This is a badass location. This is a seriously powerful opportunity right here on crude. This is a breaker block. Does everyone understand that? A breaker block is a failed order block. Failed FOB. Not an SOB, an FOB. Failed order block, okay? Inside of the breaker block, there is a fair value gap. But at that fair value gap, there's 1, 2, 3, 4, 5 levels of liquidity. There's a pool here. This is a sweep plus a fair value gap plus a breaker block. That, my friends, is a trade that I would basically take any day of the week. Why? Because you can't get any more confluence than that. Like that's like taking 2 of the 3 trade setups, merging them with a sweep. Like it's like spoon feeding a baby in this situation, right? That's the fair value gap right above the sweep. And on top of that, this is push, pull back, 1, 2, 3, 4, break a structure. There's the order block in here, right? There's a good chance that it could come up, hit this order block inside of this breaker block and react right from here. There's 2 trades here, actually. There's a breaker block, order block overlap, and then there's a fair value gap sweep. And so here's the best part. Now let's get into execution, because this is the hardest part. Everybody can learn the setups. I believe that. I believe that everybody has the power. This is the order block inside. There's 2 trades here. Remember, this is the breaker block, confluence with the fair value gap, confluence with the order block. Last up bar before the break to structure down. Everybody see that? Give me a yes if that makes sense to you guys. I need to make sure you guys get it. Now, how many of you guys struggle with how do I enter my frickin' trades? Anybody? Do I enter at the edge of the level? Do I do a confirmation entry? Do I take it in the middle? Would you agree? Would you agree that a lot of that struggle comes from only having one opportunity? So when you feel like you have less trades, you want to force the execution, or you feel that you're not going to get another opportunity, so you need to take aggressive risk. You push more for more entries. Yeah, Brian, exactly. So if I just open up 3 times more trade setup locations, okay, I've decreased the exposure of you needing to take excessive risk by 66%. So what do I mean by that? If all you were doing was taking order block trades, then yeah, I can understand that, you want to take more trades. You need more trades to make money, right? But then what everybody does is they enter at the edge of the trade. Because they see it works sometimes. And then you go on with a couple wins and you feel like $1 million. And then all of a sudden it just stops working. You had a couple first touch entries and they worked. And you feel like, wow, fuck, my stats are amazing. I'm amazing. No, you're not. You got lucky. First touch entries are about luck. And you should not try to be a lucky trader. You have no way to know that market is going to stop just because you drew a box on a chart. Let me repeat this and wake up all the kids in here. If you're going to run a business in trading, and I'm saying this very passionately with a lot of enthusiasm, maybe a bit too much intensity for the new guys, but I'm going to rip a Band-Aid off. For everybody in here that's taken first touch entries, you're basically saying, I know what the market's going to do, and I'm okay with that. Now, let that sit with you for a minute. Who in here thinks you know what the market's going to do? That's a dangerous statement. I know what the market's going to do. How many of you guys can start to understand why I'm saying this? Your job as a trader is to understand ways to reduce risk and understand ways to increase probability. Okay? So let me explain this. If you enter at the edge of the zone, you have the most risk. If you enter at the middle of the zone, you have the same risk. You have no evidence to see that this trade is going to hold. The only thing you did was decrease the size of your stop loss. But if you follow money management principles, if you have a smaller stop loss, your position sizing goes up, which means your risk didn't change. Your risk per trade is the same. So entering at the middle of a zone or entering at the edge of the zone, all it did was give you a difference between an R multiple. Now that's a different discussion. The level of expectation of you knowing what the market's going to do doesn't change, but your R multiple will change. This is the difference between entering at the edge of a zone with small zones versus entering at the midpoint with bigger zones or using a confirmation entry. Now, here's the way I would approach this, because this is something that I haven't talked with a lot of people about, and I know a lot of people question about this. Sometimes even I question about it, okay? If you're looking for some type of direction, zone entries, okay? What you need to be thinking is R multiple potential intraday, for those of you that are prop traders. For those of you in here, yeah, but the size of the move required, Tim, you're talking exactly what I'm talking about, right? R multiple potential for intraday, because if you enter here at the edge of this zone and your stop loss is here, then you got to travel all the way up here and all the way down just to get a freaking 1-to-1. That's hard. It's also not very probable that it's going to happen every single day. You're not going to get those moves every single day. During the time in which you're trading, during the time in which prop firms make you close out positions, if you're futures trading, et cetera, Forex, different story, crypto, different story. So the R multiple has to be something that's on your mind, right? The other thing is, you know, do you have a large enough R multiple to take the risk of first touch entries? Let me explain this for a second. This includes zone edge, 50%, or at outer edges. What does an outer edge mean? Well, think about this. If I have an option to choose this level, I could enter 50% of my position here and 50% of my position here. You don't know if it's going to do this and then drop. Okay. You don't know if it's going to do this, drop. If you did, your average price is here. So there's ways in which you can reduce the exposure to missing trades. If you want to enter at the edge of a zone and you feel like you're going to miss more trades, then what you can do is you can go 50% of your orders and 50% of your orders, because sometimes you're going to catch that trade and it works really well. Great. That's you got fortunate. But like I said, first touch entries are about luck, because you don't know the market's going to respond there. Nobody knows this. And so the reason I'm addressing first touch entries first is because it's normally the easiest for people to do. Everybody can understand putting a pending order here or putting an order in the middle of the zone, et cetera, because it's easy to plan that. But there's a lot of discussions that go around first touch entries that a lot of people don't talk about, that everybody struggles with. Now, my suggestion would be, and this is not going to be easy for everybody, but it has to be accepted over time. So just start recognizing that the things that make the most impact are the hardest to make the most change. It's like me. I like to eat at night. Love to snack. Love brownies. Love ice cream. Love all that shit. But what's the point if I'm going to the gym every day, busting ass, and I'm not going to make the changes, right? So if you know that there's things you could be doing, but they're not easy, but if you make those changes, they're going to move the needle for you, then my suggestion would be to start making them, as hard as it is. Now, the reason why people do the first touch entries is because they're afraid of missing out. Well, I've just given you 3 more trades. So now you have more opportunity, okay, to plan. The other thing is that first touch entries, if you're going to take them, then you need to be getting an R multiple that justifies taking that excessive risk. Think about this. I want you to write this down. First touch entries guarantee me the fill, but increase my risk. So if I'm going to increase my risk, whether it's a small zone or a big zone, I need to increase my R multiple. It has to be done. Why? Because if you don't, then you're just being a negligent trader and you will blow out your account. Like, I will lay money against you. I will take bets against a trader that is not increasing their R multiple if they're taking first touch entries. Because you might catch a string of wins, and I'm going to repeat this. Jim's guilty of it. I'm guilty of it. Everybody's guilty of it. We catch a string of wins. Wow, look at my stats. I'm moving up the needle. I'm a human. I'm amazing. And then all of a sudden, the week comes, the dreaded week around the corner, and it's like, oh, fuck, man. Like, I was on a tear and like nothing's working anymore. The strategy sucks. No, it doesn't. You didn't understand risk management. Does everybody understand this? And this is not just with zones. This is with high volume nodes, low volume nodes, supply and demand zones. Anything you do that requires a level of understanding of zone probability or levels probability, everything you do, you have no crystal ball. You have a strategy, you have a tool set to give you information, but you need to start thinking like a trader who's got to manage a book of business. So what's more powerful? If you know that over time you have 3 types of trades that you could take in this example, like if I was teaching volume profile, I could show you 4 trades. If I was teaching order flow, I could show you 3 trades. Like whatever strategy it is. For this example, we're talking price. But let's say I've got 3 types of trades. If I was only trading 1 trade setup, then I would feel the pressure of like, well, shit, if I don't catch this trade, I'm not going to make any money. I can't feed my family. I get all that. But if you've got 3 types of trade setups, your job is to get good at those trades. And then, okay, and then here's the key. You reduce the need to take the excessive risk because your FOMO is removed from increased opportunity. And therefore what ends up happening, you can start thinking like a more risk adverse trader, a more, hey, I've got to manage this capital. I need to grow this capital. I need to consistently maintain a level of accuracy. And why am I sharing this? Because I would rather you get good at getting better entries with confirmation or finding a way to reduce your risk, go midpoint, and then have shorter arm, bigger R multiples. Okay. George is asking a great question. He's like, what is the minimum R multiple? You cannot take less than a 1-to-1. Like you need at least a 1-to-1 minimum, if not 2-to-1 or 3-to-1. So if you have a zone like this and it's massive, you automatically know that that's not a one. That's you need to do a zone entry. You need to do inside the zone or do a confirmation entry. This fair value gap is different. Think about this for a second. I got 2 trade setups. This one's small. So the ability for me to take a first touch entry here allows for, hey, if I'm going to take a first touch entry, I need my R multiple to be bigger, 1.5, 2-to-1, because I have the potential of hitting that quicker. Versus here, if I have a zone that's massive like this and I can't reduce the risk, then what you do is you try to go inside of the zone and reduce the risk inside of the zone so that you have a bigger R multiple potential intraday. Now, there's a lot I've just thrown at you. It's like a fire hose. Like this is larger time frames. I'm looking at a 240. Okay, if I go down into smaller environments and I want to basically look at, say, the 60-minute chart, okay, if I'm going to go into these areas, okay, and look at this, if I know that I've got, this is an order block on a bigger time frame, and this is a fair value gap, let's just talk the order block first. This is the order block that is inside of the breaker block. How can I reduce my risk? Well, there's another order block here, the last up candle, so I can reduce my risk inside that zone, right? There's the order block. Right, now I have a smaller level. Okay. I have 2 zones now, smaller. Let's go down a little bit further. Let's go down to the 15-minute. You look inside of this area. Sorry if my opacity is a bit dark, if you can't see that, but this gets a bit noisy in here. This gets a bit noisy. Okay. However, I can tell you right now that we can see this is the break of structure here on the 15-minute. To me, this is the last down move before this up move. This is the breaker block inside the 15-minute. So now I'm basically, this is the push down, push up, failed lower high, break of structure. This last down candle before that lower high was the breaker block. Now what I'm doing, I'm stacking more probabilities on my side by saying, okay, wait a second. I'm going to basically move this down here like this. Okay. And basically reduce my risk. And now I'm basically taking a sniper's approach to, right, going into these levels and saying, okay, this is where I'm going to take the trade. This is my stab at the can. Nobody knows where the market's going to, you're not going to get perfect. That's why risk and reward ratios are there for a reason. It takes away the need for perfection. But you have a much better chance of catching a trade that's going to hit 1-to-1 or even a 2-to-1 on this chart than you did before on a much bigger zone. If you do take a first touch entry, go for a 1-to-1, 2-to-1, or even more if you're going to do a first touch entry. Does this make sense, guys? If I go inside of this fair value gap, okay, look, there's a order block, last up candle, supply zone right inside of that. If I wanted to get right down and to snipe the entry, I could do that. I could basically put my entry right here, put my stop in here. Now, I may miss the trade, but at least I know why I'm doing it. Remember this, guys. Everybody's afraid of missing trades because they're all wired backwards. Like, you're not at a loss of opportunity. You actually have so much opportunity. In fact, it's the complete opposite. You have more opportunity than someone who doesn't know anything about trading. And you have a better opportunity if you've been around a while enough to know, like, wow, if I just pay more attention, I can map out these areas. I've got multiple trade opportunities. You're afraid you're going to miss the trade, but it's the other way around. And, I've been coaching traders a long time. And I tell you, 9 times out of 10, that the reason why they take excessive risk is because they're afraid of not making money. Well, that's the reason. You're leading from a fear-based mindset. Fear is the mind killer. Fear will kill you. Greed is once you're in a good trade. Greed is a completely different discussion. Fear is about execution and discipline. Greed is about intelligence. A smart trader understands that, you need to take profits. Like, that's just key. Make sense? Like, there's a big difference between fear and greed. You can't treat them the same. They're not in the same category. Greed is the other side of the spectrum. You cannot worry about facing greed until you overcome the fear. And the fear involves FOMO, and fear involves understanding, forcing trades, not being patient, these types of things. And the goal here today is to open up exposure to multiple trade opportunities. Like, I've just taken the trade room, Jim, and added 3 trades plus sweeps in this example, which is the next section of our program. We've got a new video course coming that Jim and I are working on. And hey, Jim, like, we released the mastery level for, we just released a big program for structure mapping inside the members area, but we've been putting together material to be able to teach these advanced concepts in a much greater way. And this is just a great example of, you got a breaker block, fair value gap, order block, zone refinement. I know, Jim, you love taking first touch entries because you see them work. You see them work a lot, right? They work a lot when you're good.
Yeah, it has to be the right situation for sure. But there's definitely a ton of advantage to taking the confirmation entries too. So,
well, and I think what we'll do here, and we don't have enough time to spend confirmation entries, okay, and dropping fractals is basically taking everything that I've done now and opening us up for session number 2. Because what we've done now is we've talked about zones. We've talked about increasing confluence for efficiency. We've talked about how to increase the probability. We've talked about first touch entries and why you do things differently in certain areas, but we never did talk to you about confirmation entries. And the reason I'm doing this in 2 events is these confirmation entries is you need to understand what it is. You need to understand why you'd want to do it. Confirmation entries require you to be in front of your computer. So for those of you that like to set your levels and you don't want to sit there and have to sit there and watch and like time the market, there's 2 different people. If you're going to do first touch, you need a larger R multiple because you need to count for the risk. If you're going to do confirmation, you can get massive R multiples using confirmation, but it's more active involvement. And this is only for price action and for levels trading. This has nothing to do with order flow or volume profile and all this other shit. This is only for price action and smart money and like liquidity sweeps and order blocks and all that stuff. Like, if you're going to trade other strategies, some of these concepts don't apply. The first touch does in many ways, and risk management in many ways. But confirmation entries is about, how do I get into a zone once the market tells me I should take the trade, right? And I would like to reserve an entire, how many of you guys would like for me to do a dedicated AMA on confirmation entries? I know a lot of people have a lot of questions around that. And I think that it's warranted time now that we've got this. We'll put this video in the members area. Did you guys learn something today? Was it well received? I know it's a lot of information for a lot of people. If you're new, it's like, wow, and Sean gets on a tear sometimes. But I do. But I mean, I've been around long enough to know, like, there's a bunch of bullshit and there's a bunch of facts. Let's get into the facts and help people. right?
Well, and here's another thing too, guys, is if you're going to take first touch entries, you're putting more pressure on yourself to have a higher probability in your trades, because if you don't have that higher win rate, you ain't making any money. So you have to be a master at refinement, and you have to master the your hit rate has to be really high, and it's undue pressure on the trader. So
now we've talked a lot about, like, let's just go back up now to the 240 for a second. I'm just gonna do this. Okay, so let's just take a look at this for a second. Okay, so here's a great example of like we've talked about. Let's just clear the chart. Okay, so let's just clear the chart for a second. And, you know, we've talked about the, like take a look at this, this level here. Like just this low, like this low really kicked ass. Like it was a really, really big move, right? And it came into an order block. But let's talk about it for a second. Like if we're always looking at it from the short side, but let's look at it from the long side, right? If you're looking at it from this perspective, this is the last up move before the down move, right? This is the last up candle before this pullback. But this pullback didn't break structure. It's a weak low until it broke this high. So this becomes an order block that failed. This was an up candle that led to this pullback. So when you think about looking at it from the opposing side of things, watch what happens. There's the order block. Okay, now let's just, there's the breaker block. Now this is what we call a breaker block, right? This was the order block that led to the pullback that became a breaker block. So if you look here now, just never mind this wick touch, because that's not what I'm looking at. I'm looking at this order block. This down candle was what led to the true boss break. That's a strong low, and that's a weak high. Weak high can still produce a breaker block. We talked about that. Weak highs and lows, internal structure can do that. But this is a breaker block to the long side that overlaps an order block to the long side. And so if I'm going to draw another zone here, where did they come to? Not just a breaker, not just the order block. It's an order block overlapping the breaker block, which to me is valuable. Now, if you're not paying any attention, I don't know what to do here, but what do you see here? This is the last lesson for the day before I fall off the chair from lack of caffeine. Right? Like, what do you guys see here? Where's Tony Lang? The fair value gap. What do you see here inside this breaker block? This is a breaker block. So let's take away this order block for a second so you can see a little clearly. Wow, wait a second. Look at the fair value gap inside the breaker block. Not every fair value gap, because look, this one here came in, this one reacted fine, but it's not inside of anything. Like, this is why it closed the gap. It's not inside of another area. You want to look for these things that are inside of your breaker blocks. Your breaker blocks are the answer that the market failed from one side, so it has to test the opposing side. Like if resistance fails, it has to test support on the other side. That's just support and resistance 101. But where do you do it? Right here on this level? Do you do it on the confluence of this level? Everybody always has a question as to where do I draw the support and resistance? Well, this is resistance. Everybody can see the highs, everybody can see the lows. Well, that's not how the market works. The market doesn't work every high and every low to perfection. If that was that easy, shit, we'd all have AI running at ChatGPT 101 and we'd be all fine. That doesn't make any sense. You need to go into this resistance to say, okay, where is the real area? You need to go into this resistance and say, okay, where inside of this is the market likely to come back to test properly? And sometimes you don't have any confirmation. You just have a breaker block. I personally would not just want to enter on breaker blocks by myself. This is why I like to look for confirmation for, yes, a breaker block can work, but why would you not want to just do something like this and catch that trade on crude? Like, that's a massive trade. And it's a really clean entry that makes exact perfect sense to everything that I've just taught today. Makes sense, guys? How many of you guys like this level of education? Like, did you guys learn something? Give me a yes here. If you guys felt informed, you walk away valued, everything here is a win. Yeah. I've just scratched the surface. Jim and I have just scratched the surface, right? And these AMAs are designed to help you understand the level of what we teach inside the gap, as well as ongoing stuff that will keep coming. I think, Jim, what we'll do is we'll run a poll here. Okay. So we have a gap program. For all of you in the gap program, can I ask a question? Can you do me a favor? And this is for all the new people in here trying to find a home. I'm going to open up the chat to everyone. Can you do me a favor? If you're in the gap program, this is not scripted. I don't know who's in here. There's a lot of gap members, a lot of non-gap members. If everybody could just change in the chat box to everyone so that when you reply, it goes to everyone. For those of you in the gap program, can you just leave a comment like, is it good? Is it shit? Jim and I don't know what we're talking about. Like, like just whatever. I don't care what it is. Like, just be straight, because I'm as transparent as it gets. That's why we weeded out all the monkeys out of the Discord. Like, even the best traders that everyone thought was great, they're all fake and phony, and they're lucky they're not in jail. So, really, Jack Jensen's stats are bullshit. Love it, Jack. Appreciate it. Yeah, I think some people question like break evens versus a win. I'll tell you my perspective. A break even to me is always a win. I always count that, Jack. That was on purpose. So just know that this wasn't Jim. This was me. As a trader who's I've managed millions of dollars and I've actually managed 60 sub accounts as a collective 2 leader. Like, I know a first thing or two about liquidity trading. It's not always about stroking the win rate. It's about not losing money. Straight up. Like, a lot of people don't get that, is that they just think it's about the hit rate. I would rather take a week or two of break evens if it means I'm not losing. If something's going on in the market or if I'm in a drawdown, a break even is a win to me. So that's why we allocated that. Yeah, it's how much you keep. It's not always how much you need to be to stroke your ego. So I know some people don't agree with that, but at least I'm open about it. Like, I'm not here to try to hide around that. Break evens we consider a win because you didn't lose. That's a win to me. Right? And some people agree with that and some people don't. Right? So why did I open that up? Right? The reason I'm asking this is, well, I'll tell you this. Okay, I'm gonna close this off here now because let's do this for a second. I'm gonna run a poll because everybody in here that's not in the GAP program, you may be struggling. I don't know, or maybe you've been going to some of our webinars and you don't know what to expect, or you want to learn this stuff. Like, Jim runs a room. We post all the trades pre and post. So one of the things you're going to find inside of our Discords, and I'm going to show you, is let me just do this for a second. Exactly. Brian says, when you blow an account, you wish you had more break evens. Well said. That's okay. You can take a horse to water, but you can't make him drink. So when you go into the Discords, okay, we have a section in here. Don't worry about all the other stuff, but at the top, we have a section for gap, okay? Now we break the gap down. I'm going to talk about this for a second. We break the gap down. Everybody can basically come in. And this is important for everybody looking for community, because it's not just about the members area. This is not just about the education. This is more about like what you can expect to help learn with the people in the program. We have a live trading section where we post live picks. Okay. We'll go into that in a second. But what we do is we have an instructor pre-plan section for futures. We have an instructor pre-plan section for FX. We have an instructor pre-plan section for crypto. Why do we do this? Because the people that get it and they know it and they understand it, You don't need me and Jim. You've been in the program, you've been in the trade room, you understand it. You're just kind of mastering your craft. You're trying to become better, right? Like some of you guys said you're an experienced trader in here this morning, right? You're always learning, right? But for those of you, which is 80% of you, maybe more, you need help. We know this. So the goal is there's three things you need to do. Number one is you need to learn the education. Okay, that's E. Okay. Then you need to come to the classroom. That's C. Okay. Then you need to get good. Okay. ECG, your heart. It's the heart of what you do. I just made that up because I want to be fancy. But the point of the matter is that you cannot get good until you learn how to do things. And while you're learning, a lot of people want to make money, or they want to feel like, hey, I just bought a program. I want to make use of it. I want to basically make sure that I'm not just putting more money into education. I want to really master this trading game, or I've been blowing out evals, or I don't know what to do. We're going to feed you trades. So we're gonna map out everything. We're gonna map out different areas. Now these are order block trades, but Jim's gonna be adding fair value gap trades. Jim's gonna be adding breaker block trades. We're gonna be adding liquidity sweeps in here. This is just ongoing trades that all we do is post levels for you to understand. These are pre-planned trades, and then what ends up happening is live trading picks, futures. When you take live picks, we teach them, we take them, and you're gonna notice that we always place our fills. We always show you what we're doing. You can go back and cross-reference all the pre-planned trades to all the live trades. Win, lose, or draw, we're going to basically put them in here so that you can understand it, right? You're going to see them. If you go in here to the Forex, right here, instructor plan Forex trades, okay? Confirmation entries. We'll do this. This is just an example to show you. We post all the pre-planned levels, okay? Live trading picks, Forex, right? Look, we even post a stop out. Imagine that. Shit happens sometimes, right? Right here, T1 before it blew through. Students posting trades. I don't know who that one was. Right here, like we're just gonna post them all. You're gonna see them. Like this was me posting levels on the euro. This was you can go through and you can look at this. These are all of the live trades, so that it's not just about learning. You can actually see that people are doing it. We're basically putting it there for you to understand. And then you can go in here to the main chat rooms and you can communicate with everybody and do all that fun stuff, because that's the whole point. Now, the reason I'm showing you this is because the education room, the education portal is very, like there's a lot of training in there. There's a lot of great videos in there. You'll be able to access that ongoing. But Jim runs the room in the mornings and you can come in there and you can do all that. Okay. And so I'm going to put a poll in here because I'm not here to try to pepper you. I'm not here to just try to like buy now. Like if you want to ask questions and if you want to speak to a trader, or if you want to basically get in touch with us and say, how do I do this? Or I'd like to consider this and I want to do this, then just fill it out. If you have coupons for ARC or for NeuroStreet, maybe you've bought products for the past and you basically have a bunch of coupons, we can allow you to stack your coupons so you can use these towards your purchase. If you haven't bought it, you have coupons, et cetera, et cetera. So all I'm going to do is I'm going to ask that everybody here just fills out the link. And if you don't have any coupons and you want some, and you want a discount, Jim will throw a few your way. Just let us know. Like if you want to use your coupons that you've maybe got from ARC, you can use them. If you're at a point where, you want a discount, you want to join, then yes, great. We'll give you extra coupons. We'll give you a discount. You can come in, but you're going to have to talk to Jim first. Jim will reach out to you. A lot of you are already members. A couple of you now are saying, yes, I'd like some extra coupons. Great. For those of you that would like a couple extra coupons, then let us know. And Jim's going to reach out to you personally and get you set up, right? He's going to help you out with a good deal. He's going to get you in on the program. Dean is saying, yes, please, for the coupons. The coupons can be used for the purchase, right? So if you want to basically come into Gap and you want, Jim will throw you some coupons, get you a deal, get you in and get you moving forward, right? There's a bunch of you saying, yes, Jim, you're going to have some people to talk to. Do me a favor, guys. Jim is a busy man. Out of respect to me, him, and my team, if he reaches out to you, like we're all professionals here. Can everybody just agree that we're going to reply or get on a call and, show up for a meeting? Like, it's a pain in the ass when people book time and give you their time and they don't respond, or that, it's not an entitled business. We don't have to teach you what we know. Right. So it's, a lot of you are already members. That's great. There's a whole lot of you that are members. So, and some of you that are not sure yet, for those of you that are not sure yet, can you just type in the chat box, would you like us to contact you, and we'll give you more details and we'll talk about it. Jim can do a walkthrough of the back end. He can show you what's going on with it. Like, for those of you that are still unclear, you've got a lot of questions, and just do me a favor and just type in the chat box. Yes, I need more guidance, or I want to talk to someone, or whatever that means, right? So I think that's it, Jim. I think there's a lot of people that have not answered. Can you do me a favor? There's a lot of people in here. Just answer one of the polls, just so we know. We've got a lot of people in here. Let us know if you would like to join and you would want a deal. If you, are already a member, just answer you're already a member. If you have prior coupons and you want to combine them, like maybe we've given you ARC coupons or any coupons before, you can stack them together for your purchase. Yeah, Devon, yeah, you need some guidance? No problem. We'll get you squared away. We're here to help, guys, right? We've got about 60% participated. That's great. Help a brother out. For all of you that are asking for coupons, Jim will follow up. And for those of you that are not sure, Jim will also follow up, right? And for all of you that are members, I'm glad to have you guys here. Thank you for your business. Thank you for your support. I promise you more more information is going to be coming with TickBlaze. More information is going to be coming with the prop firm. All of the indicators and the integrations. This is exciting. Exciting time. Yeah. All right, guys. So you want some more info, Greg, on the GAP program? Perfect. Yeah, we'll get in touch with you. As long as you fill out the poll, Jim knows to get in touch with you. We can't read your mind, right? So fill out the poll, guys. If you need help, let us know. Right. And we're going to be doing another AMA on this, on confirmation entries. I'm in the middle of signing contracts for, Willie's asking a great question. Is TickBlaze a new platform? Oh, baby. It's a coming. And it's a coming with, let's just say things are about to change in the industry. Things are coming. I think they wrote an old Western song. They'll be coming around the mountain when you come. I don't know, man, but it's been a 2-year project, and something big is coming, guys. And it's going to change a lot of the prop firms. It's going to change the industry. How many of you guys are sick and tired of paying data costs? How many of you guys get sick and tired of paying for data? What would you do if you had a cell phone? Now think about this. What if you had a cell phone, and when you buy the cell phone, it came with data? It came with your plan. Like, think of this. Like let's say you bought your phone. Maybe you're with AT&T. What if you bought a Samsung? And because you bought Samsung, they had an agreement with AT&T that you got your data plan. Wouldn't that be great? That you don't have to worry about all these extra costs, like all these extra fees. Do you know that everybody in the industry marks up their data, like, massively? Yeah, things are going to change. Things are changing. Things are coming, and it's going to be exciting. So anyways, guys, that's it. I can't talk about it yet. We need to wait until the contracts are signed, but let me just say it's coming. So all I can tell you is things are happening, and it's going to be good for everybody. And it's going to be exciting for everybody that uses our software and everybody that is in the prop programs and everything like that. Yeah. So guys, thank you for your attendance. A lot of members came here today, so thank you for showing up. A lot of new people in here. Glad to be here. And hopefully you guys learned something. So I'm going to leave it at that. Jim will follow up with you guys. Enjoy the rest of your day, and take some of the stuff that I've taught you today and look at your charts. Don't rush into just taking trades, but spend some time with some screen time. Like, spend some time looking at it, right? I assure you, it's going to make it worth your while. Okay. So that's it. Take care, guys, and we'll see you in the next event.
Take care, everybody.